Welcome to the Overberg Asset Management Market Review. In this episode, Nick and Gielie shares with us the highlights of the markets, both globally and in South Africa.
Good day and welcome. I am Nick. So we start off just briefly, capital economics, a view on the US inflation. The Fed's favorite inflation gauge is Personal Consumption Expenditure Index, core services excluding housing inflation. Sounds very complicated, but manufacturing prices are coming down. The real difficulty is with core services. Housing inflation also coming down, but the core services, which excludes housing inflation, comprises 56% of the index, and that portion of the inflation puzzle is not showing much of a slowdown, and that is a problem for the Fed. It is heavily influenced by the strength of the labor market, and it now appears to be the measure that the Fed is tracking most closely. Capital economics expects PCE core services ex-housing inflation to fall from 4.6% in March to 3.5% by the end of 2023. A more significant easing in labour market conditions is going to be needed in order to bring inflation back to the Fed's 2% target on a sustained basis. So that is slightly disappointing considering how bullish and confident capital economics used to be about inflation coming down rapidly. They also add that inflation expectations are rising. So the University of Michigan survey measure of households' long-term inflation expectations rose in May to a 14-year high. Now we're turning across to the next segment, MRB, just generally talking about the difficulty of the market, very difficult market to navigate. They believe that that the counter trend decline in developed market bond yields appears to be unwinding. So we've seen that in the last 3 weeks. The 10-year US Treasury bond yield has increased from 3.4% up to 3.7, 3.8. There's also been a recent rebound in US policy rate expectations. It's the thinking before the last Fed policy meeting was 1 and then we're done, but now it looks increasingly likely we'll have yet another 25 basis point rate hike from the Fed in July. So global financial markets continue to churn, swinging rapidly between optimism and pessimism. The environment in recent years has had so many unique features versus previous decades that most investors lack conviction in the outlook and thus are wary of making large bets and are quick to bail. The good news is that the shock of the SVB bank failure has faded and bank credit default swap indices have calmed down. But another upleg in the bond yield market is brewing. So if you look at the charts, it definitely looks as if that is an imminent danger. Let's look at the unusual economic backdrop in the major economies. The most unusual thing is that traditionally the manufacturing surveys and the services surveys used to be in sync, but at the moment they are moving in opposite directions. The unusual nature of the firstly of the pandemic, and then the pandemic policy response, and then the post-pandemic economic recovery have caused this abnormal behavior between the two main economic sectors, manufacturing and services. Historically, they moved together. Now they're moving in opposite directions. Housing data have continued to improve and are now indicating a positive contribution to real GDP growth, having suffered from negative contributions over the past 8 consecutive quarters. Inventories also negative for the past several quarters, and they are now turning positive, ready to boost GDP positively. The phasing out of the housing and inventory drags on GDP represents a powerful countervailing force against a recessionary down cycle. The good news, the bank crisis appears to be over. The current generation of investors will forever be looking over the shoulder in fear of another 2008 financial crisis. This was once in a multi-generational event, having huge ramifications for portfolios, careers, policy, etc. However, perspective is important. The problems are with a select group of poorly managed banks rather than something widespread or systemic, and do not involve a deterioration in underlying credit worthiness. So we are looking maybe at reweighting Polar Capital Global Financials in the global portfolios, comprising mainly of bank shares. Because of the recent weakness, that share is now tremendously under model weighting. So it could be a very good opportunity to reweight. Banks are incredibly cheap. What do MRB have to say about inflation and bond yields? There's no doubt inflation in 2023-2024 will be lower than the peak readings witnessed in the past year, but they should still be well above pre-pandemic levels and central bank targets. Bond markets will eventually reflect such an outcome, regardless of whether central banks respond quickly to reduced recession risks and sticky inflation, or once again lag as occurred in 2021-2022. So either way, bond yields are going up. So enough of the depressing reading. We've got a very interesting, quite unusual, I would say, non-consensus report from Alpine Macro, and it definitely bears listening to. So first of all, earnings. That is the background. And it's particularly to do with US corporate earnings. So counterintuitively, after an 18% drop in earnings last year, operating earnings per share appear to have bottomed out in the fourth quarter of 2022, while earnings expectations are now rising anew. And their whole thesis is based on the difference between nominal earnings and real earnings. So relatively high inflation may offer some protection to nominal earnings. Corporate revenue and profits are nominal variables, and intuitively rising prices should help rather than hurt corporate profitability. The recessions in the 1970s and 1980s were severe, but earnings drawdowns were much milder than those in recent decades when low inflation prevailed. So let's fast forward to today's situation. Is it possible that elevated inflation will continue to help companies retain pricing power and thus decent earnings growth, even if the economy falls into a mild recession? The answer is possibly yes. And let's look at the arithmetic. Nominal GDP growth is real growth plus inflation in the States now stands at about 6.9%. Real growth slightly more than 1.5%, while inflation measured by the GDP deflator is at 5.3%. So assuming a mild recession reduces annualized real GDP growth to zero, and inflation falls by an additional 150 basis points by year end, would mean that nominal GDP would still be growing at around 4%, which is the same as the average nominal growth rate during periods of normal economic expansion since the global financial crisis in 2008, 2009. And over that normal economic expansion period, operating EPS growth was 12.3%. So potentially we could also have a period of 12.3% nominal EPS growth, even if we go into a mild recession. The key risk to our constructive view is a scenario where inflation reverses its downtrend and creeps higher. That would entail continued monetary tightening, which in turn could provoke a severe recession and a double dip in share prices. But this is not our baseline scenario. Gielie, that's all from my side. All good, obviously, apart from the macro in South Africa, all good on the local side.
Yeah, Nick, thank you very much for a very upbeat macro report. Let's go over to statistics. I think the statistics that came out this week is actually much more interesting than the company news. The South African inflation rate came out last week, and it's good news. The March year-on-year inflation rate, so that was the previous month, that was up 7.1%, but now in April it was down to 6.8%. That's very encouraging. And what makes it more encouraging is that it is an 11-month low. It is still above the target range of 3.3% to 6%. And the biggest contributor to this drop was transportation costs. Then the core inflation is another story. Core inflation excludes food and fuel mainly. The March one was flat at 5.2%, but then in April it went up to 5.4%, and this was a 6-year high. So they can't get the core inflation under control, which is a pity. If you look at the interest rates, the day after the inflation rates, the interest rates came out. The interest rate decision, the repo rate was set at 8.25%. That's up from 7.75%. And the prime overdraft rate was up to 11.75%. That's up from 11.25%. And what is interesting, the vote for these percentages was unanimous. While these rates go up, it's just interesting that our share market is still cheap. The all-share index, the earnings yield at the moment is 10.88. That's very low. It has been lower than that in the past, but it very seldom go below 11%. And now it's sitting at 10.88%. The money supply figure, the M3, also came out. The report is that the April figure was up 10.1% year on year. The March figure, the previous month, was up 8.9%. This is interesting that this M3, the long-term graph, is really a steady upwards graph. It's not very volatile. It moves smoothly, just one way it goes up. And then the private sector credit extensions, that's what the money lending is to businesses. The March one was up 7.2%, and then the April one was up 7.1%, both year on year. And what is more, it was the 22nd consecutive month of growth in the private sector credit extension. If you look at this graph over the long term, it's very volatile, it's choppy. That's in contrast with the M3, which is a very flat and stable graph.